Hey gang, welcome to Time in the Market episode 10, I think. It's been a while since I've done an update on one of these, but I thought it'd be a good time to do that since the portfolio has done very well in the last couple of months. Last time I did an update was in July. Now it's the middle of October. The stock market has done very well since then. Who would have thought? And I'm up 29%. Part of that is deposits, but a lot of that is growth. And I think the story of this update is basically, hey, my growth industries portfolio is continuing to kill it. If I share this pie and I kind of look at how these guys have done, these companies have done in the last quarter, it's up 20%, 21%. So that's pretty impressive in the last year. This portfolio has doubled in size. So I've been really fortunate in really benefiting from these growth names doing very well. And I hope that continues, but I think these are priced very aggressively at this point. So we'll see. My dividend aristocrat portfolio has done less well, but it's still positive, it's still in the positive return. So we're talking about a change from 42,457 in my M1 finance account as of July 8th. Now we're up to 54,824. Forward income has gone up quite a bit as well. So, $12,000 in gains and deposits in 3 months is pretty damn good. You can kind of see this graph. It's going up quite a bit. Now I have been depositing more money. I obviously took advantage of the dip in March to put a lot of money to work here, and that's benefited me greatly because things have done really well since then. But that's a big jump here, and I kind of wanted to take a deeper dive in what's driving that. So I did a more of an outline of what part of this growth is deposits, what part of this growth is actually increases in the value of the stocks that I hold. So you can see the data here in July of 2020. We were at $42,000. That was a 9.4% growth over the prior month. I have some data hidden here that kind of shows you some additional information, but I hid it just for the sake of making this easier to read. But you can kind of see that, hey, I deposited quite a bit in May, March, April, and that's really helped out, helped the portfolio grow since then. So, we had a 4.6 return on the aristocrats portfolio. We had a 14.1% return on the growth portfolio from the month prior to that. Overall, the portfolio was up 9.4% outside of the deposits. So it was just, the deposits were 2,700. The growth was about 3,600. So 9.4% against 9.2% growth in the S&P 500 in that same time frame. Since then, since the 42,000, I've deposited another $4,000. So I'm very lucky to be able to deposit $4,000 in 3 months. But I've seen almost $8,000 in growth. So that 12,000, most of it, or not most of it, a good portion of it is from growth. So the dividend aristocrats portfolio, which actually saw more deposits, is up 11.5%. Without those deposits, the growth portfolio is up 21.9% since the last update without those deposits. So, I'm up 29% overall, 16.9% return against an S&P 500 return of about 9.5% in that time frame. That's pretty darn good, guys. I'm pretty excited about this. What I also did is I kind of went back to the beginning of the year and said, hey, if I had a portfolio of 22 grand that I started with, if I invested it in my portfolios, the growth portfolio and the dividend aristocrats portfolio, how would it have done against the S&P 500? And the results are pretty good, as you can see by some of these numbers. In March, this includes deposit, obviously, so there wasn't really a lot of growth initially. Obviously, there was a dip in March, started to go up in April. I put a lot more money to work through April and May rather, and onwards as the values were there. And there was a pretty big gap between where the S&P 500 went and where I went in terms of portfolio growth. And a lot of that was driven by my growth portfolio and continues to be driven by my growth portfolio. If we go back to this, right, the growth portfolio is 29 grand right now. In the last quarter, it's up 20%. In the last year, I mean, if you look at the growth since March, we're up over 100%. We dipped into the $90 range, starting at a $100 point in last October. We were down into the 90s. Now the portfolio is back up into the 200 range on a $100 basis. So 90 to 200 is 120% return. So anything I bought here and here and here and here and here and here, which I was buying a good amount of, has returns in the 60 to 100% range. That's pretty darn good. And that's what's driving the difference here. The S&P 500 has done pretty well. If I go over here, I have the S&P 500 open. It's up 18% in the last year, but 18% is good, but it's not 106%. So that's why this deviation started to happen, as especially in the last couple of months, these portfolios have been, the growth portfolio especially has been really, really hot, as a lot of these growth names have exploded. So, if I invested 22,000 in January, if I kept it in the S&P 500, and I have a lot of money, and some money rather, in the S&P 500, I'd be at 46,000. But since I have it in my two portfolios, I have a $54,000 total right now, which is a good gap. And a lot of that is driven by the difference in return on that growth portfolio. Do I expect that to continue? I don't really. I think these stocks are priced very attractively now. So you can kind of see that I've shifted my contributions more towards the aristocrats, which have done okay, but they've sort of dragged behind. They've really impacted my portfolio negatively, because if we go back over here, we had a 4% return when this portfolio was returning 14%. We have an 11% return, which is good, but this portfolio is returning 22%. So obviously, if I put my money into the growth portfolio entirely, I would have done a lot better. But the point here is that I have two separate portfolios, two separate investing strategies, one that's based on dividend growth, one that's just based on pure growth companies that are going to zig and zag in different directions. Obviously the growth companies have done amazingly well, 100% return in the last year. If we go to the dividend aristocrats portfolio, which is a decent chunk of change too, copy that, share this pie, and I'll post these links on the bottom. I don't have the data back to 1 year because Raytheon Technologies split 4-1, so the data is kind of muddled. But, it's a 9% return in the last quarter. Obviously, that's a lot worse than this. If I look at the 1 year, I think it's about in line, if I remember correctly, with the S&P 500, which is, 18-19%, which is still very good. But obviously, it's not 100%. So when you look at this number, why am I outperforming the S&P 500? It's because I have a heavy allocation to growth, and that growth portfolio has done amazingly well. And I keep putting money into it. I put $1,900 into it since July, but more of my money is going into the dividend aristocrats portfolio. So it's going to improve my yield. You can kind of see that my forward income is going up. It was $683 in July. It's more $860 in August, and I've seen that in the dividends that I'm getting from these portfolios as well. If you go back to the growth portfolio, the yield here is almost zero. It's 0.4%, because there's a couple of companies here that pay dividends, like Microsoft, Apple pays dividends, but a lot of these companies are growers, fast growers that are investing their money in growth versus paying dividends, which is fine. And then if you look at the dividend aristocrats portfolio, the yield is 2.7% almost. So obviously more yield focused, more focused on dividend growth. So that drives the majority of the income that I get in these two portfolios. You can kind of see that the additional money that I've put in and the growth in dividends that the dividend aristocrats portfolio has accrued has really helped me take these numbers up quite a bit. In 2019 altogether, I was at $169 in dividends. As more and more money flowed into the portfolio through September, I'm already at $416, and forward income is going to go up quite a bit. So you can kind of see that, hey, last September I had $24 in dividends. Now I have almost 3.5 times as much in $81. September's a big month because a lot of companies pay at the end of the quarter, but some of these other months are pretty big too. So, I was at $169 in 2019. In 2020, I'm going to be in the $600-$700 range from these portfolios, and that number is only going to continue to grow as I put more money into the portfolios. So has anything changed in the portfolios themselves? Aristocrats, no. It's still 65 companies. If you don't remember, you can watch some of my initial videos about what these portfolios entail. But these are companies that have raised their dividend 25 years in a row and are in the S&P 500. So these are large cap companies that are growing their dividends and continue to grow their dividends. These are historically sound, profit-making companies that will hopefully grow their dividends well into the future. And I can not only benefit from the increase in stock price, but also from the growth in dividends that will come with that. And some of these companies may cut their dividends, in which case they will be removed from this portfolio. But the ideal company for this is one that continues to grow their dividends year over year over year. So my income keeps compounding, and the dividend, the yield on cost that I get, so basically the amount I pay for a stock in relation to the dividends they pay in the future keeps going up, because they're raising their dividends year over year. And on the growth side, I did make some changes. I do have a blog. If you guys don't follow it, it's timeinthemarket.com, where I kind of do some more frequent updates. Well, not really more frequent, but different timed updates. And I did one last 2 weeks ago where I kind of talked about the changes I've made in the portfolio. And basically, I removed Fleur, which is a sort of a company related to aviation, and I didn't really like the earnings report that they released, and wasn't really thinking that it was a good fit for the type of portfolio that this is, which is focused on growth. And on the opposite end, I added Fastly, AVLR, and CrowdStrike, 3 growth companies that have done pretty well since then already, actually. And then I also added Teladoc, because I've talked about this before, I do have a position in LVGO, which is being acquired by Teladoc. So the way M1 works is if you don't have a company in your pie and the ticker changes, so for example, if LVGO, whenever that gets acquired, the ticker is going to change to Teladoc, TDOC, and if I didn't have TDOC in my portfolio, it would just sell all of my shares of LVGO because, it doesn't exist anymore. Rather, it's sell all my shares of Teladoc because it doesn't exist in my portfolio. So that's why I added it. I do think both companies are good. I probably would have preferred if LVGO, I keep calling it LVGO, it's Livongo, I think, right? Stayed on its own, but both are good growth companies that I plan to hold into the future. But beyond that, no major changes. If you look at the activity on the dividend portfolio side, I kind of talked about those dividends growing as the portfolio gets bigger. That's happening. That's starting to happen. If I look at these numbers, when I looked at this portfolio in the beginning, a lot of these numbers were in the cents. I was getting 19 cents, 20 cents, 30 cents, 40 cents. Now, anytime I get a payout, it's a $2, $3. It's still not a lot of money per share, right? It's still not like I'm getting $20 each of these payouts, but this number will grow. Not only am I putting more money into this portfolio, but I'm also experiencing the growth that comes whenever these companies raise their dividends. So, that's the benefit of a growth focused dividend portfolio, that, hey, maybe this year Kimberly Clark pays a dividend of $2.32 in October. Even if I didn't add any more shares of Kimberly Clark, next year in October, they probably would have raised their dividend a bit. So from the shares I hold, I might have gotten $2.35. It's not a lot. The growth doesn't have to be huge. Let's say they may raise their dividend 1 to 2%. Some of these companies may raise it a lot more. But overall, it compounds, it adds up, and the portfolio yield keeps growing even without any additional money flowing in. But I do think that these companies are good long-term holds. I do think that they can outperform the S&P 500 in the long run, and I'm putting more money to work for me. So not only am I going to benefit from the additional growth due to the companies raising their own dividend, but also the fact that I'm putting more money and can reinvest that dividend on a bigger scale in the future. So, I'm starting to get to a point where these monthly payouts, $81, reinvest 2.7% yield means every time I get an $81 payout in a month, I get an additional $2 in forward income in the future. So it starts adding up. $2 isn't a lot. But $2 becomes $4, becomes $8, becomes $12, becomes $20, and soon, a couple of years down the line, it doesn't happen overnight. That number becomes bigger and bigger and bigger, and I can reinvest more and more and more money into the dividend-paying stocks, and that's really the goal with this portfolio. And while this portfolio has done far and away much worse than the growth portfolio, I do think that there's probably some more values here in relation to that other portfolio now than there used to be, which is why I'm putting a bit more money here than I am over there. I still think the growth portfolio has some upside, but it's, anytime something goes up 100%, it either means that, hey, I've done an amazing job of picking stocks, or the market has just valued something very aggressively because of one reason or another. And the reason for that has been the pandemic. A lot of these dividend aristocrats stocks, if you look at some of these holdings that have done poorly, there's gas companies. This one doesn't count because it was a split, so the number's off. It was retail companies, it was banks, it was REITs, real estate investment trusts, basically companies that either depend on rent, or companies that depend on retail, or companies that depend on customer spending in certain ways, like gas. Obviously, if I'm not going to work, I don't need to get gas. I've honestly gotten gas like 2 or 3 times in the last 6 months versus getting it basically weekly or bi-weekly before that. So demand is obviously not good on these gas companies. Airplanes use oil, they use fuel. Not a lot of airplanes are flying these days. So these companies have struggled. But there are still good companies within this portfolio that have returned very well. Home improvement companies, certain retail companies have done very well. You can see some of these returns are in the 30 to 100 plus range since I've gotten some of these stocks. So Clorox has done well. So it's not all losers. There's some losers here, but most of them are still winners. It's just that they're winners on a smaller scale than the growth companies. So if we go to the growth companies, look at the same growth, there are a few losers here. Not too many. Some of these companies that are related to air travel or military spending haven't done super well. But on the other side, you've got some ridiculous winners. Tesla's up 640% since I got it. Trupanion is up 200%. JD, Etsy, Trade Desk is up a lot. Square, so e-commerce, fintech, stuff with pets apparently is doing amazing because Trupanion's up 300%. Again, Livongo, which I talked about, which is being acquired by Teladoc. C, which I added, I talked about it maybe 2 updates ago, 3 to 4 months ago. It's already basically doubled since I've gotten it, which is just absolutely ridiculous. Some of the other stocks that I've gotten, that I've added recently, I added Fastly maybe a month ago, and it's already up 40%. So the ability for some of these stocks to just explode overnight is there, which is why this portfolio has done so well. So just wanted to do a quick update here, guys, show you where the portfolio still is. I think I'm going to start making videos on a more regular basis here. And I think I'm going to talk about more just investing topics, maybe do a how to invest, the basics of investing series, besides these updates, which I think will be fun. Hopefully you guys enjoyed this update. Hopefully you guys are doing well on your own. Again, growth has done well. Do I expect it to do as well as it's done going forward? I don't think so. I do think that the stock market is pretty fairly valued, but you also have to relate that to what else is available out there, right? If I'm going to not invest in the stock market, do I invest in bonds that are basically paying zero? Do I invest in real estate? That's sort of murky, especially on the commercial side. So there aren't a ton of options out there, which is why stocks have done so well despite all of the stuff that's going on in the world. Anytime you have 0% yields that are basically going to stay 0% forever, you can kind of look forward to stocks doing well. It's not to say that things aren't going to change and there might be a dip in the future. If there is, I'll go back to buying growth stocks. But right now, I think I'm going to invest more in the dividend aristocrat portfolio while still investing in the growth stocks, but maybe, on a kind of reverse what I was doing in the past, where I was really more focused on the growth stocks. Now I'm going to be more focused on the dividend aristocrat stocks. That's going to mean good things for my forward income. So dividends should go up, which I can then reinvest in other things. It might mean my growth portfolio doesn't grow as much as it did in the last month. I mean, it's hard to complain about a 14% return in basically a month and then another 22% on top of that. I can't expect that that's going to continue for much longer. You know, if it does, hey, all the more power to those of us invested in growth stocks. But the ride's probably going to end sometime, and when it does, you know, and if it drops, I'll buy more growth stocks at that point. I do believe that these companies are 10-year plus holds that are going to do well. Not all of them will, but I think a lot of them will be multiplicative in the return I get, and in that I'll get 2, 3, 4 times the money I put into them. I think that's less likely at these prices, but it's certainly more likely at the prices we saw in March, April, May, even June, because I was buying these companies hand over fist, and I've been rewarded very well since then. So I'm glad to see that, and I'm hopeful you guys are doing well on your portfolio as well. I'll post the links to the portfolios in the bottom, as well as the link to the article in my blog where I talk about the changes. As always, you know, this is a video series I'm doing for fun. If you want to invest any serious money, be aware that investing in the stock market carries risk of loss, including total loss, meaning your money could go to zero if you pick the wrong stocks. I am long any of the companies I talked about in this video, as well as the companies that are represented in the portfolios that I will link. As always, you should talk to a qualified investment professional before you make any investments with your money. I'm just doing this video series for fun, and hope you guys enjoy it and stick along for the ride. So thanks for watching, and I'll see you again soon.